Namaste. Telugu Prajala Mana Sakshi Sakshi TV. Welcome to Fun Factor Show. I'm your host Swarna. Today I'm pleased to once again welcome Srinivas Penugonda and Kent Keith from Next Level Finance Advisor at Ameriprise Finance for the fourth edition of our multi-show series on finance for immigrants in USA. Sri and Kent have written as our resident experts on financial planning and investing for their financial shows, and today we are continuing with our part 2 of the topic, the advanced financial planning process. Before we know more about that, if you are a CPA and would like to join our Fun Factor talk shows, please email us at usa@sakshi.com or you can call us at 866-725-7441. Before we begin the show, the information provided in this show is not a legal advice. It's for general information purposes only. Sakshi TV or its agents are not responsible about this information as a legal advice. If you need any specific information, please contact CPA directly. Without any further delay, let's start our show by welcoming Mr. Sri and Mr. Ken. Hi, Mr. Sri. Hi, Mr. Ken.
Hello, it's good to see you again.
Hi, Swarna. Good to see you.
Good to see you. Thank you. So last week, you showed us on overview of a financial plan you were working on of an actual client of yours. I believe this week you are going to give us a detailed look at the investment plan you created for them. Is that right?
Yes, Swarna. So, Swarna, every client is different. They have different needs and they have different financial goals. So it's a risk-reward situation, right? So as an advisor, when we meet with the clients, we ask them, hey, how much risk can you take to get a desired return? So based on their risk tolerance, we listen to the clients and we kind of customize the portfolio for them.
So wonderful. Let's bring your investment plans up on the screen and you can lead us through it.
So if we're just scrolling through the 4 pages to give you an overview of what the entire document looks like, you can just see there's, a page we saw last week, which is an assortment of their investments arranged in a particular way. On page 2, we're talking a little bit about income planning, and then the meat of the proposal starts with the investment plan proposal itself, which will outline each specific portfolio that should be in which account, whether it's an IRA or a taxable account, or maybe an outside account. And then we always finish up with what are the next steps? What does the client need to do? What do we need to do in order to keep moving this ball forward?
See on page 1, you see the original investments that the clients have at various financial institutions. Usually, our typical clients, they have assets all over. Sometimes they are at different places. They have no idea what they are and where they are.
Correct.
So if you see here, these clients, they have, their assets at different places. So we kind of giving them an idea to consolidate all their accounts in one place at Ameriprise. And the ones that is in blue is, where it kind of tells you the strategies that, we are suggesting to them when they roll over their accounts or when they bring in the accounts to here.
Yeah, this is interesting because we don't always do this. This client was specifically saying, but where will the Morgan Stanley money go? Where will this 401k go? And because they were sort of thinking of it in that way, we decided that we would, in blue here, right next to the account that they currently have, write down what strategy that particular piece of money would be going into. It's not always laid out like this, but this client, we just thought it was a better way to work with them. And so we customized it for them.
Yeah. So if you see it in blue, we may not be able to go through each and every strategy, but the first one, it says they have a variable annuity, and we are suggesting them to cash out on the annuity because, their entire asset base is like $5 million. And from this annuity, they're going to get about, less than $10,000 per year. And for a client who has a net worth of over 5 million, 10,000 is just like a drop in the bucket. So we suggest that they move out of the variable annuity, and we suggest that, we are offering them to roll that money into a high yield portfolio.
Yeah, that's a good point. I mean, we don't always say cash out your annuities, but an $800 a month annuity for somebody who's going to need a substantially larger income, it just didn't make sense. And so we're getting rid of it. But if we jump to page 3, that really is sort of the heart of what we're proposing today and what we want to look at today. This is the actual investment plan where you can see the specific investment portfolios or products that we are suggesting and what type of account each one of those pieces of money, what strategies they're going to go into.
Yeah, the specific recommendations we have for them.
Several strategies you outline here, and I don't think we can go into them in details, but we can focus on anything today?
Yes, let's do that. I think that's the best idea because, as you point out, there's several portfolios in here. Each one has its own purpose, and they're important. And so we go over these strategies and we say, hey, look, for this piece of money, this is what this strategy does, and this is what it's going to do for you. This is how it fits in the portfolio. But in this case, let's focus in on just a couple of them. We did recommend a couple strategies that solve specific problems. Mm-hmm. And the qualified opportunity zone is one that you can see third down on the page there. The client has worked for tech companies throughout their career, starting at Google, moving to Airbnb, now working at Stripe. And this has really contributed to their wealth with stock options and RSUs, registered stock units, but that's just stock, right? And so with options and RSUs, they have now created, with these 3 hot, quick, really 2 right now, but Stripe is likely to go public soon. These are quickly advancing stocks. They've made a lot of money over the years. And so they now have a big tax problem. If I sell this stock, I'm going to get killed with capital gains. And they specifically pointed out to us that they were not interested in paying those taxes. Was there any way we could help them sort of avoid doing that?
I think one of the main reasons that they reached out to us is that the previous advisor suggested to them to
sell a big chunk. They paid a big tax bill, and at the end of the day, they just weren't happy about it. They didn't feel that they were well informed, mm-hmm. and they also didn't feel that the strategy was well thought out. And so, coming to us from the place where they were, and specifically pointing out their tax problems, one of the solutions here is a qualified opportunity zone. Now, a qualified opportunity zone is really a tax change that it's a tax program, right? The tax code is used by the US government to get people to do the things that they'd like them to do, including save for retirement. We'll give you a tax break if you'll save for retirement. Well, an opportunity zone in all 50 states, there are opportunity zones, neighborhoods that they say we need to revitalize. These are not great neighborhoods. Mm-hmm. They're older. The buildings are falling down. We need people to invest to make those neighborhoods better. But people are not investing because they don't think they'll get a good enough return on their money. Mm-hmm. So the government says, well, we can increase the return on your money by giving you tax breaks, by investing in the opportunity zone. So the way the qualified opportunity zone works, and it started about 5 years ago, importantly, this is the last year the opportunity will persist. And then the opportunity to invest in one of these funds that invests into an opportunity zone will go away December 31st. So while we have the opportunity, we said, we will use your Airbnb RSUs that have about $300,000 worth of capital gain in them. Now, there might be 4,000, there's about $100,000 worth of stock, but only 300,000 of that is capital gain. So we're going to take that capital gain and put it into the QOZ, Qualified Opportunity Zone Fund. The benefit you get with that type of fund is this. The money that you have, you no longer have to pay your capital gain on this year. I sold the stock, so we realized the capital gain. But if we put the capital gain into the fund, then we no longer have to do that, pay the capital gain. We sort of kick the can down the road and we have 10 years to pay no capital gains. That Opportunity Zone Fund is going to invest in real estate in an opportunity zone for you. And you would expect that over 10 years, you might double your money. So if you put in $300,000 10 years later, you will have made about $300,000 if everything goes well. You will now not have to pay capital gains on the $300,000 you just made. Tax-free, you can take the money and pay no taxes. The original $300,000 that you were supposed to pay capital gains on 10 years ago, you will get a 10% discount. You still have to pay your capital gains, but you got to wait 10 years, make probably about 100% on that money tax-free, and you'll pay 10% less capital gains. So this solution for them ended up being fairly elegant. It only works if you don't need your money for 10 years because you need to leave your money safe. But this is a $5 million net worth individual, and the $300,000 they could afford to put away for this amount of time.
That sounds smart about Airbnb stock. But what about Google stock, and what do you want to answer about that?
Yes, they also had the Google stock that also had capital gains problems, and the Google stock was actually more money, over $500,000. We didn't want to suggest to them that they put all of their money into this one strategy, the Opportunity Zone Fund. And it's possible that they could need that money before 10 years. It's unlikely, but it's possible. So we just didn't want to lock it up that long. Now, just below where you see Opportunity Zone Fund, you will see where it says Exchange Fund. Now, that's another solution. It works a little differently, but we were suggesting to them that we take the Google, that a big problem for Google also, not only were there tax problems there, but there is what we call concentration risk, too much of their portfolio in one stock. And we don't want to keep, more than $500,000 sitting in one stock. So in the exchange fund, what we're doing is we take these shares, we do not sell the shares of Google, we give them to the fund and we exchange them for $500,000 worth of the fund stock. Now that fund is entirely made up of other stocks that people have contributed into the fund. I say entirely, there's actually about 10% of the fund that they will invest in another way. But primarily the fund is other executives, CEOs, or people who got options and RSUs, and they exchange them into these funds because instead of only owning Google, and if something bad happens to the Google stock, they lose a lot of value. Instead, they own all the different stocks that have been exchanged into the fund. Now, the shares of their fund, they do not have to sell. In fact, they're not allowed to sell them for a number of years. So you're still locked up for a bit. But it immediately diversifies you. You didn't sell your shares, so you never actually incur any capital gains. And it's a way to diversify and kick the can down the road on your stock that you're not prepared to sell right away.
So these are complex tax planning strategies that we offer to our clients who have concentrated positions in stocks like Google or Facebook.
Yeah.
So these are some of the advanced strategies that we offer.
Yeah, and they're not for everybody. You need to be an accredited investor to even qualify to go into these funds. And then we use the other funds, the other strategies you can see here, like the core portfolio, that we're managing stock portfolios, we manage risk or growth, going for growth, and we mix and match those types of strategies.
So I see that your core portfolio is a risk managed portfolio. Can you tell us more specifically about that?
Yeah. So in the world of our portfolio management team that Sri and I both sit on is managing all these portfolios together. Sri, however, takes the lead on the growth portfolios. He has an expertise in technology stocks and growth stocks, which he has focused on for years. And I sort of take the lead on the risk management strategies, because that goes back to my background when I was a commodities trader, and we used a lot of options and hedging strategies to keep highly leveraged portfolios in check. This risk management strategy is an ETF, that's an exchange traded fund, similar to a mutual fund, but just follows an index. And we use ETFs to build a broadly diversified portfolio, stocks, bonds, alternatives like gold and real estate, things like that. So if you looked at the portfolio, you'd say, that looks like a good portfolio, broadly diversified, sort of about 80% stocks, 20% bonds type of thing. There's actually also 15% alternatives in there. And so on the surface, it looks like a traditional diversified portfolio. Underneath, what we're doing, we're taking every single one of those sectors, every sector inside the S&P 500, different pieces of international markets, developed markets, emerging markets. Some of those, are actually currency hedged and some aren't. And we're looking at what percentage of those we should do. And then the bond markets, domestic, international, TIPS, WIPS, inflation protected bonds. And so all of those individual pieces, we then put an overlay of technical analysis. And when it tells us that one of those sectors is trending down and it's time to get the money out, an alarm goes off and we say, let's remove this sector and we're going to put it back into the sectors that are still doing well. And so this sort of invisible to the client or to anybody who's looking at the portfolio, technical analysis overlay is actually having the money move around in increments as the market moves. What really happens, the risk management piece is, so there's a small, difference in a normal market. But if you get into a bear market and all the sectors start coming out, and it's 2008 and the market's going to go down 40%, this portfolio has already pulled all of those sectors out. It's buying US treasuries, converting to cash, and it's buying gold. And so that we use that as a core strategy because it's really built to protect you against very bad bear markets. And it's very difficult. We never say never, but really it's very tough for that strategy to follow the market and lose, because it doesn't follow the market. It will pull you out before. And that's why we manage risk that way. Use it as sort of a core portfolio.
So, Mr. Kent, your core portfolio is a risk management. So do you have any other portfolio that doesn't have any risk?
Absolutely.
Yes. Yeah. Actually, if you see at the bottom of the page, on page three,
yeah,
that, we have two portfolios. One is a growth portfolio, and the other one we call the stat portfolio, which is more kind of a momentum portfolio. So the growth portfolio is for a little bit longer term, and the stat portfolio is more of a momentum portfolio. So for both those portfolios, we may not have the risk management tools, but we do look at the technicals on a daily basis.
But those are aggressive portfolios. That we are not trying to have a managed risk. We're saying, let's go beat the market.
Right.
Right.
Yeah. So those are for clients. I have some clients that say, Shri, I want to be aggressive. So they are willing to take the downside risk. So that's one of the reasons we don't have the risk management tools for those portfolios.
Yeah, if you're going to apply risk management, important point, the risk reward balance. So we take away risk management in order to enhance reward, right? And this client, you can see, there's 8% suggested in the growth portfolio, 2% in the stat portfolio. So 10% of aggression. The client doesn't need a lot of aggression. What the client needs is tax mitigation. And that's why in this plan, we have a lot of, ideas about how to keep them from having to pay a bigger tax bill. But aggressive portfolios, even for someone in this, you want some piece of that to drive. Yes. You got some juice in that portfolio, right? Yeah. Another client might have 40% of their portfolio in the growth and stat portfolio, right?
Right, yeah. Like, the risk management portfolios may not give the return of like a growth or stat portfolio.
They will not.
Yeah.
They will not.
So you do need some growth at the end of the day. So for a portion of the portfolio, we suggest the client has some exposure to these growth and stat portfolios.
Right.
Shri and Ken, there is so much here to unpack, and we are out of time. We will put up your contact information. If anyone would like additional information, you can reach out to Shri and Mr. Ken directly. This has been more excellent information for us. I'm looking forward to the next show when you come back and talk about advanced financial planning part 3 with us.
Absolutely. We're looking forward to it. In that part, we were going to do an actual financial plan, a retirement plan, looking at the future. And I think it'll be very interesting for clients to actually see the output of the technology that we use to be able to see what a future-looking financial plan looks like.
Definitely. Retirement plan sounds like a really interesting plan. Everyone should know about it. So I think definitely it's going to be a very interesting.
Everybody needs a plan.
Yes, that's what it is. Everybody needs a plan, especially retirement plan. Yes.
Right.
That's all we have time for us today. But please stay tuned in for next Fun Factor show. This is Swarna signing off. You're watching Telugu Prajala Mana Sakshi TV. Namaste.